The Investor Cycle, From Chaos to Calm in 9 Stages, a book on mastering the mindset of wealth.
Chapter 1 Greed Surge, GameStop's Soaring. I can't believe how fast these stocks are climbing. Everyone on Reddit is raking in thousands overnight. I'm jumping in now before I miss the ride of my life.
Picture this. It's January 2021, and I'm scrolling Reddit at 2 a.m., bleary-eyed but wired. The Wall Street Bets forum is a wildfire of rocket emojis, memes, and screenshots. Guys claiming they turned $1,000 into $50,000 in a week. GameStop, a random video game store I hadn't thought about since I was 12, is the star. The stock's shooting from $20 to $100, then $200, and the posts scream it's headed to the moon. My heart's pounding. I've got $500 sitting in my savings account, earning nothing but dust. This is it, I think. My shot at serious money. I open my Robinhood app, mash buy, and I'm in, riding the wave with the internet's diamond-handed rebels. I'm not just investing, I'm part of a revolution. Part of me wondered if I'd regret this, but the excitement drowned out that quiet voice. That's the greed surge. It's the moment you dive headfirst into the market, driven by a cocktail of excitement, urgency, and pure, unfiltered greed. You're not thinking about balance sheets or price-earnings ratios. You're chasing a dream, a rush, a chance to be the guy who made it. And trust me, I've been there. Maybe you have too. This chapter's about unpacking that wild, reckless energy, what's really going on in your head, why it feels so damn good, and how to keep it from burning you alive.
The Psychology FOMO's Siren Song.
Let's get into the brain stuff. When you see a stock like GameStop soaring and everyone online cashing in, your mind doesn't stay calm and collected. Nope, it flips a switch. Psychologists call it FOMO, fear of missing out. It's not just a catchy acronym, it's a primal force. Back when we were cavemen, missing out could mean no food, no mate, no survival. Today, it's missing the next big thing. And in the greed surge, that thing is money, status, and bragging rights all rolled into one. Your brain's reward system goes haywire here. Dopamine, that feel-good chemical, floods in every time you imagine those gains. It's the same hit you get from a slot machine's flashing lights or a like on your latest post. Scientists say dopamine doesn't just reward success, it rewards the chase. That's why I felt invincible clicking buy at 2 a.m., even though I didn't know a short squeeze from a bear hug. Then there's social proof. If everyone's jumping off the cliff with parachutes made of GameStop stock, it must be safe, right? Behavioral economist Robert Shiller calls this herd behavior. We're wired to trust the crowd, especially when they're winning. Add in scarcity, this won't last, and you've got a perfect storm. Your rational brain, the prefrontal cortex, gets drowned out by the lizard brain screaming, act now or lose forever. I wasn't thinking about risk. I didn't Google GameStop's revenue or ask why a dying retailer was worth billions overnight. I saw dollar signs and rocket ships. That's the greed surge, a dopamine-fueled, herd-driven sprint into the unknown.
The emotional high and hidden low.
Emotionally, this stage is a roller coaster climb, pure exhilaration with a whisper of dread. I was buzzing, texting friends, dude, I'm in on GameStop, up 50% already. My palms sweated as I refreshed the app, watching my $500 morph into $750 in hours. It felt like I'd hacked life, a secret shortcut to wealth the suits on Wall Street missed. But there's a shadow. Under the hype, I felt twitchy, restless. What if I'd waited too long? What if I didn't buy enough? FOMO's a double-edged sword. You're thrilled to be in, terrified you're not in enough. Every Reddit post about $1,000 by Friday stoked the fire, but also the fear I'd miss the peak. It's greed with a side of panic, a high that's already teetering toward a fall.
My story, the $500 rocket ride.
Let me take you back to that week in 2021. I'd never traded stocks before. My financial know-how stopped at Venmoing rent. But GameStop was everywhere. Reddit, X, even my cousin's group chat. It's sticking it to the hedge funds, they said. A revolution. I didn't care about the revolution. I cared about the money. Posts showed kids my age turning lunch money into car payments. I wanted that. So, I downloaded Robinhood, linked my bank, and threw in $500. Half my savings. No research, no plan, just vibes. The app's green confetti popped when I bought at $150 a share. By morning, it hit $200. I was up $333 in hours. I strutted around my apartment like a Wall Street wolf, plotting how I'd spend my millions. I didn't sleep. I refreshed, posted, dreamed. It felt like I'd cracked a code. Spoiler, I hadn't.
The fallout waiting to happen.
Here's the catch. Greed surge is a sugar rush. GameStop didn't soar because it invented time travel. It soared because Reddit's army squeezed short sellers, a fluke of market mechanics I didn't grasp. Options buying amplified the squeeze, forcing shorts to cover via a gamma effect. The stock hit $483 that month, but I didn't sell. I was diamond hands, holding for $1,000 like the memes promised. Then it crashed, hard. By February, my $750 was $120. The high faded, the regret didn't. That's the trap. Greed surge blinds you to reality. You're not investing. You're betting on a wave you didn't create, hoping it carries you forever. It won't. The numbers don't lie. GameStop's market cap ballooned to $24 billion with no profits to back it. FOMO doesn't care about balance sheets, but markets do.
Counteracting the surge, taming the beast.
So, how do you ride the greed surge without crashing? You don't have to kill the thrill. Investing should feel alive, but you can cage the chaos. Here's how I wish I'd played it. Pause the frenzy. Force a 24-hour delay before buying. Write down your why. GameStop's hot because Reddit says so sounds flimsier on paper. Most hype can't survive a night's sleep. I'd have saved $500 if I'd slept on it. Cap the madness. Set a strict limit, say $100, for hype buys. Treat it like a Vegas budget. Fun money, not rent money. If I'd capped at $100, I'd have lost less sleep and cash. Reality check. Look up the stock's history. GameStop's 5-year chart. Flat, then a spike, then a cliff. Hype's a blip. Check the trend. I didn't, and I paid for it. These aren't killjoys, they're guardrails. Behavioral finance guru Daniel Kahneman says it best. The best way to think about risk is to not think about it when you're excited. Step back, breathe, limit the stakes. Greed's fun until it's not.
The lesson I learned, so you don't have to.
That $500 GameStop fling wasn't my finest hour, but it was my first. I didn't get rich, I got schooled. The greed surge taught me that investing isn't a lottery ticket or a Reddit uprising. It's a game of odds, and I'd played with none in my favor. I wasn't mad at the market, though. I was mad at me. That anger lit a spark. I'd figure this out, not just follow the next loudmouth online. If you're in a greed surge right now, crypto pumping, a meme stock spiking, feel the rush. It's human, but don't let it own you. Pause, cap, check. The rocket's thrilling, but the crash is brutal. Trust me, I've got the scars to prove it.
Chapter 2. Crash Panic. Oh God, what have I done? My money's vanishing in real time. Every alert's a gut punch. Why didn't I cash out when I was up? I'm an idiot for not selling yesterday.
3 days after my GameStop high, I'm a wreck. It's late January 2021, and the stock's free falling. $483 to $200, then $150, then lower. My phone buzzes with Robinhood alerts, each one a dagger. Minus $100, minus $200, minus $300. My $500 bet, briefly $750, is now $250 and sinking. I'm glued to the screen, refreshing like a madman, stomach churning. Why didn't I sell yesterday? I mutter, pacing my apartment. I saw it at $200. Why didn't I cash out? I'm such an idiot. Every dip feels personal, like the market's laughing at me. I'm not a Wall Street wolf anymore. I'm a deer in headlights, frozen as my money bleeds out. Welcome to Crash Panic. It's the moment the greed surge dream shatters, and you're left staring at red numbers, drowning in regret. Your brain's a mess, your gut's worse, and all you can think is, what have I done? This chapter's about that spiral, why it hits so hard, how it feels like the end of the world, and how to stop it from breaking you. I've been there, and if you've ever watched a stock tank, you probably have too. Let's unpack it.
The psychology, loss, hurts more than winning feels good.
Crash panic isn't just about losing money, it's about losing control. Psychologists call it loss aversion, and it's brutal. Behavioral economists Daniel Kahneman and Amos Tversky found that losses sting twice as much as gains lift you up. My $250 drop hurt way more than my $250 gain thrilled me. Why? Your brain's wired to prioritize survival. Losing resources feels like a threat to your life, even if it's just a trading app balance. Then there's the amygdala, your brain's panic button. When GameStop crashed, it lit up, screaming danger, like I'd stepped on a snake. Rational thought? Out the window. My prefrontal cortex, the part that plans and reasons, was offline, drowned by fear. Add hindsight bias. I knew it'd crash. And you've got a perfect storm of self-torture. I didn't know squat, but in retrospect, I convinced myself I'd seen it coming and blown it. Regret's the kicker. Every should have sold thought is a mental lash. Psychologists say we overestimate our control after the fact. It's why I beat myself up for not cashing out at $200, as if I'd had a crystal ball. In Crash Panic, you're not just losing cash, you're losing the fantasy of what it could have been. A new car, a paid-off loan, a smug, I told you so to your skeptical friends. That's what makes the gut punches land.
The emotional spiral, fear, shame, and paralysis.
Emotionally, Crash Panic is a blender on high. Fear hits first, raw, visceral terror as numbers plummet. I'd flinch at every buzz, dreading the next $50 alert. It's not just money, it's security, pride, slipping away. Then shame creeps in. I'm an idiot, I'd think, imagining my friends laughing or my bank account mocking me. I'd gone from genius to fool in 72 hours, and the mirror wasn't kind. Paralysis sets in next. I couldn't sell. Too scared to lock in the loss. Couldn't buy. Too broke and broken. I just stared, refreshed, cursed. It's a weird mix. You're frantic inside, but stuck, like a hamster on a wheel going nowhere. The market's a horror movie, and I'm the idiot who didn't run. My story, the $500 crash landing. Let's rewind to that week. I'd ridden GameStop's rocket from $150 to $200, feeling untouchable. Diamond hands. I'd posted on Reddit, parroting the memes. Then the shorts fought back, the hype faded, and the stock tanked. Day 3, I'm down 50%. My app's a sea of red, and I'm a mess, pacing, muttering, checking X for hope. It'll bounce, some guy tweeted. Hedge funds are done. Another buzz, minus $50. Nope. I'd refresh every minute, heart sinking with each drop. Why didn't I sell at $200? I'd yell at my cat who didn't care. I'd been up $250, enough for a new phone, a weekend trip. Now I'm staring at $250 total, half my stake gone. Every alert was a punch. You blew it. I'd lie awake, replaying the peak, cursing my greed. I wasn't just losing money, I was losing my nerve.
The fallout, panic's price tag.
Crash panic isn't cheap. GameStop's plunge wasn't a fluke. Stocks like it crash hard when hype dies. By February 2021, it was back to $40, a 90% drop from its peak. My $500 could have been $1,000 if I'd sold high. Instead, I held, panicked, and watched it shrivel. The data's clear. Retail investors like me often buy high, sell low. Studies show we underperform the market by 1.5% a year because of emotional flops like this. The real cost? My headspace. I was a zombie, snappy with friends, glued to screens, drowning in what-ifs. Panic didn't just tank my account, it tanked me, and that's the trap. You think you're reacting to save yourself, but you're digging deeper.
Counteracting the panic, pulling out of the spiral.
You can't stop a crash, but you can stop the panic from owning you. Here's how I'd redo that week, and how you can next time the red hits. Breathe, don't break. Step away. Phone down, walk outside. Panic feeds on tunnel vision. 10 minutes off screen resets your brain. I wish I'd left my apartment instead of refreshing like a bot. Wait it out. Set a 48-hour no-sell rule. Most crashes bounce or settle. GameStop spiked back to $150 a week later. I'd have kept $50 more if I'd chilled. Behavioral science backs this. Time dulls the amygdala's scream. Reframe the fall. Losses aren't failures, they're tuition. Ask, what's this teaching me? For me, it was hype's not a strategy. Writing that down turned panic into purpose. These aren't magic, they're lifelines. Nobel Prize winner Richard Thaler says emotional decisions in crashes cost us big, waiting beats, reacting 9 times out of 10. You're not powerless, you're just human.
The lesson I learned, so you don't have to.
That GameStop crash was my first gut punch, and it landed hard. I lost $250, sure, but the real hit was my confidence. I felt dumb, duped, done, yet that panic sparked something. Lying awake, I realized I couldn't outrun the market's chaos, but I could outlast it. I didn't need to be a genius. I needed to be steady. If you're in crash panic now, screen red, heart racing, feel it. It's real, but don't let it run you. Step back, wait, reframe. The market doesn't care about your should have sold spiral, but you can. I didn't know it then, but that crash was my first step to growing up as an investor. The gut punches fade, the lessons stick.
Chapter 3, Desperate Sell. Gotta grab something. I can't take more losses. I'm selling now to snag whatever's left. Better to salvage something than watch it all disappear and regret it later.
It's early February 2021, and I'm done. GameStop's down to $80 a share. My $500 dream is now $120, and every tick lower feels like a sledgehammer. I've been refreshing my Robinhood app for days, watching the red bleed deeper, my stomach in knots. I can't take this anymore, I mutter, thumb hovering over the sell button. The Reddit hype's gone silent. X is a graveyard of told you so posts, and I'm convinced it's headed to zero. Better grab something now than lose it all, I think. Click, sold. $120 hits my account. Teresa texted, told you it'd crash. I exhale, like I've just escaped a burning car, then slump. I'm out, but I'm gutted. That's desperate sell. It's the moment you hit eject, trading hope for relief, locking in losses to stop the pain. You're not thinking long term. You're surviving. This chapter's about that frantic bailout. Why your brain screams, get out. How it feels to ditch the dream, and how to keep from selling yourself short. Literally. I've been there, and if you've ever hit sell in a panic, you know the drill. Let's break it down.
The psychology, running from the pain.
Desperate sell is fight or flight on steroids, and flight wins. Your brain's in survival mode, driven by what psychologists call myopic loss aversion. It's a fancy term for a simple truth. You'd rather take a small, certain hit now than face the unknown of a bigger crash later. Losing $380 of my $500 hurt, but watching it drop to zero felt unthinkable. Behavioral economists say we're wired to cut pain fast. Evolution taught us to drop the hot rock, not hold it hoping it cools. Then there's regret aversion. I wasn't just scared of losing more, I was terrified of kicking myself later. What if it hits $10 tomorrow and I didn't sell? That fear's a beast. It twists your gut, whispering worst-case scenarios. Your amygdala's still in charge from crash panic, pumping adrenaline, while your rational brain's muttering, maybe wait, from the back seat. Guess who's driving? Sunk cost fallacy should keep you in, I've lost so much already, might as well ride it out. But it flips here. Instead, you think, I've lost enough. I'm done. It's irrational, but it feels like salvation. You're not selling a stock. You're buying peace, even if it's a lousy deal.
The emotional roller coaster, relief, then regret.
Emotionally, desperate sell is a split-second high followed by a long low. Clicking sell felt like dodging a bullet. My chest loosened. My breathing slowed. At least I've got $120, I told myself, like I'd won a consolation prize at a rigged carnival game. Relief washed over me. I'd stopped the bleeding, escaped the torture of watching it sink further. But that relief? It's a liar. An hour later, I'm staring at my $120 balance, and the math hits. I've lost 76% of my stake. The something I grabbed feels like nothing. Despair creeps in, then anger. At myself, the market, Reddit's hype machine. I'd traded panic for a new torment. What if it bounces back? Spoiler, it did, to $150 a week later. The relief was a mirage. Regret was the real payload.
My story, the $120 escape hatch.
Let's rewind to that February day. GameStop's crash had me spiraling. I'd gone from 750 to 120 in a week, and every dip was a fresh wound. I'd refresh my app, see $50, and curse. Reddit was a ghost town. No more to the moon chants, just bitter should have sold threads. X was worse. Told you it was a scam. I felt trapped. Every minute I held, I lost more. But selling meant admitting defeat. By day 5, I broke. It hit $80 and I couldn't breathe. It's going to zero, I thought, picturing my $120 vanishing like smoke. I opened Robinhood, hands shaking, and hit sell. The green confetti popped, mocking me this time. $120 landed in my account, and I exhaled. Better than nothing, I said, trying to believe it. I shut my phone, walked away, told myself I'd dodged a bullet. Then I checked a week later, $150. I'd bailed at the bottom. My something was a self-inflicted wound.
The fallout, the cost of cutting loose.
Desperate sell isn't just a financial hit, it's a pattern. GameStop's crash wasn't unique. Meme stocks like AMC and Bed Bath & Beyond followed the same arc. Hype, spike, plunge. Data backs it. Retail investors sell low 60% more often than pros, per a 2021 study from the National Bureau of Economic Research. My $120 could have been $225 if I'd held a week. That's the price of panic, locking in losses when patience might have paid. The deeper cost was trust. I didn't just lose cash, I lost faith in myself. I can't do this, I thought, swearing off stocks for months. Desperate sell doesn't just empty your account, it empties your nerve. And that's the trap. You think you're saving yourself, but you're setting yourself up to miss the rebound. Counteracting the desperation, holding the line. You can't undo a crash, but you can dodge the desperation sell. Here's how I'd replay that week, and how you can next time the market kicks you. Check the bones. Before selling, ask, did the company tank or just the hype? GameStop's stores didn't vanish. Its price just did. Fundamentals outlast panic. Dig into earnings, not headlines. I'd have seen it was oversold, not dead.
Tax the tears. Run the numbers.
Selling at a loss might save you taxes. Selling $380 loss offset approximately $57 at 15% tax rate per IRS rules. Is that worth it? Math cools the frenzy. I'd have paused if I'd crunched it. Hold a lifeline. Keep a small percentage of your stake, enough to limit pain, but big enough to ride a bounce. If I'd sold $450 and kept $50, I'd have felt relief and caught the uptick. These aren't about being a hero. They're about buying time. Behavioral finance guru Mir Statman says panic selling's the biggest wealth killer for newbies. Waiting beats bailing most days. You're not stuck. You're scared. That's fixable.
The lesson I learned, so you don't have to.
That 120 sell was my rock bottom, not because I lost 380, but because I lost my grip. I didn't save myself. I surrendered. But here's the flip. That sting woke me up. I'd been a passenger, reacting, not thinking. Selling low taught me the market doesn't care about my fear, but I can. I didn't need to outsmart it. I needed to outlast it. If you're in desperate sell right now, watching red finger on sell, feel the urge. It's real, but don't let it win. Check the bones, tax it, keep a peace. The crash isn't your fault. The bailout doesn't have to be your fate. I sold my way out of GameStop, but I bought my way into a lesson. Panic's loud, but patience pays.
Chapter 4, Wake Up Call. Where'd I screw up? I need to face it. I wasn't investing, I was gambling blind with the crowd. Time to crack a book and figure out where I went wrong.
It's mid-February 2021, and I'm staring at my $120 Robinhood balance, my GameStop fortune after selling at $80. The app's taunting me with its green plus button, but I'm not touching it. I'm done chasing memes. I slump on my couch, replaying the crash, and it hits me. I didn't know what I was doing. I jumped into a hype train with no brakes, no map, just Reddit vibes. I wasn't an investor, I was a gambler, and the house won. Where'd I screw up? I mutter, grabbing my laptop. I Google stock basics, crack open a library copy of The Intelligent Investor, and start scribbling notes. I'm mad, embarrassed, but weirdly fired up. I'm not quitting, I'm learning. This is the wake-up call. It's the moment you stop running from the wreckage and face it. Your losses, your ignorance, your herd mentality. You're not a trader yet, but you're not a sucker anymore either. This chapter's about that pivot. Why your brain finally wakes up, how it feels to own your mess, and how to turn shame into a starting line.
The psychology, dissonance meets curiosity.
Crash, panic, and desperate sell leave you raw. Now your brain's wrestling with cognitive dissonance. That's the psych term for when your self-image, I'm smart, slams into reality. I lost $380 on a meme. It hurts, but it's fuel. Your prefrontal cortex, the thinking part, kicks back online, tired of the amygdala's tantrums. You're done reacting. You want answers. Curiosity's the spark here. Psychologists say setbacks trigger a need to make sense. It's why I Googled, why did GameStop crash, instead of sulking. But there's a trap. Self-criticism can spiral. I'm an idiot loops in your head, and overthinking can stall you. Too many books, too much guilt. The wake-up call's a tightrope, reflection without drowning in it.
The emotional shift, shame to resolve.
Emotionally, this is a gut punch with a chaser of hope. Shame hits first. I felt dumb, like I'd failed a test I didn't study for. My $380 loss wasn't just money. It was proof I'd been a lemming. But then resolve creeps in. Flipping through The Intelligent Investor, I felt a flicker. Maybe I can do this right. It's humbling but energizing, like shedding a skin that never fit. You're not proud yet, but you're not broken either.
My story, the $380 epiphany.
Post-sell, I avoided my phone. Every Robinhood buzz was a reminder of my flop. But one night, I couldn't sleep. What happened? I wondered. I'd followed Reddit like a cult, bought high, sold low, no plan, no clue. I grabbed my laptop, searched Investing 101, and fell down a rabbit hole. Articles, YouTube, a dusty library book. Page 1 of Graham's classic hit me. Investing is about value, not speculation. Ouch. I'd speculated my savings away. I scribbled notes, research companies, ignore hype, feeling dumb but driven. I wasn't ready to trade again, but I was ready to learn. That $380 stung, but it lit a fire. I'd screwed up and I'd fix it.
The fallout, ignorance's price.
GameStop wasn't my fault. Hype crashes happen, but my ignorance was. I didn't know short squeezes, PE ratios, or even what GameStop sold beyond old PlayStations. The fallout. Beyond $380, I'd wasted time. Weeks of FOMO and panic I could have spent learning. Studies show newbies like me lose 2 to 3% more annually from dumb moves. Knowledge isn't free, but ignorance costs more. Counteracting the overthinking. Start simple. The wake-up call can paralyze if you let it. Too many whys bury you. Here's how to keep it moving. Start small. Pick one resource. The Intelligent Investor, a podcast, not 10. I'd have drowned if I'd tried it all at once. Journal it. Write your screw-ups. No research. Herd vibes. Seeing I followed Reddit in ink killed my denial. Celebrate the shift. Buy a coffee for starting. Growth's worth a $5 cheer, not just a guilt trip. Psychologist Carol Dweck calls this a growth mindset. Mistakes aren't you, they're lessons. Keep it light, keep it moving.
The lesson, Shame's a teacher.
That $380 loss was my first real mirror. I'd been a hype chaser, not an investor. But facing it flipped the script. I didn't need to be a genius. I needed to start. If you're here, licking wounds, asking, where'd I go wrong? Own it. Crack a book, take a note. The wake-up call's your reboot, not your end.
Chapter 5. Bold Guess. NVIDIA's my jackpot. I've done my homework. NVIDIA's AI chips are gold. 3 articles say they'll dominate, so I'm a genius now, right? This isn't GameStop. I get it this time.
April 2021. I'm back. GameStop's a bitter memory, a $380 lesson etched in my gut, and I've got $300 burning a hole in my pocket, scraped from odd jobs and a tax refund. I'm not the same newbie who chased Reddit rockets. I've cracked the intelligent investor, skimmed some blogs, watched a few YouTube explainers. I'm eyeing Nvidia, the chip maker everyone's buzzing about. AI's the future, I think. Scrolling 3 articles on my phone, Forbes, TechCrunch, some guy on Medium. Self-driving cars, data centers, gaming, this is legit. I'm no meme stock sucker now. I've got research. I open Robinhood, buy at $180 a share, and smirk. This isn't GameStop. I'm a genius. 3 days later, it's $190. Told you so. This is bold guess, half-educated swagger riding the wake-up call's momentum. You've cracked a book, learned a term or two, and think you've cracked the code. Overconfidence slips into the driver's seat, and you're betting big on a hunch dressed up as insight. It feels like a victory lap after the crash, but the ground's still shaky. This chapter's about that cocky pivot, why your brain puffs up, how pride blinds you, and how to keep it from biting you twice. I've strutted this stage. Maybe you have too. Let's unpack it.
The psychology. Overconfidence takes the wheel.
Enter the Dunning-Kruger effect, the psych trap where a little knowledge feels like a lot. 3 articles and a chapter of Graham made me an expert, blind to the 10,000 hours I hadn't logged. Psychologists David Dunning and Justin Kruger found that beginners overestimate their chops. Competence breeds confidence, not caution. I knew AI was hot. NVIDIA made chips, and chips were gold. Done deal, right? Wrong. I didn't know supply chains, competition, or valuation. I just knew enough to feel smart. Months later, I saw how little I knew. Confirmation bias fueled the fire. I hunted NVIDIA hype, articles screaming AI revolution, and skipped the risks. Chip shortages, market cycles, pfft, not my problem. Behavioral economist Dan Ariely says we cherry-pick data to fit our story. I wanted a win, so I saw winners. My brain wasn't researching, it was cheerleading. You're still speculating in bold guess, but with a strut, thinking, this time's different. Spoiler, it's not always.
The emotional high, pride and peril.
Pride's the star here. I was buzzing, smug, texting friends. NVIDIA's my pick, up $50 already. My $300 was $316 in days. I felt like Warren Buffett in sweatpants. GameStop's ghost lingered, a twitch of doubt, but I drowned it with, I've learned. It's a high, pure and electric, like I'd cracked life's cheat code. I'd strut past my laptop, glancing at the green, imagining millions by 30. I wasn't just an investor, I was a visionary. But peril's the shadow. That twitch wasn't nothing. It was my gut whispering, you sure? I ignored it, too busy basking. Pride's fragile. One dip, and the genius mask cracks. I didn't know it yet, but I was teetering, half cocked and half blind.
My story. The $300 bet.
Post GameStop, I'd sworn off trading until boredom and a $300 windfall reignited me. I'd studied, sort of, Graham's book, a Motley Fool podcast, those 3 articles. NVIDIA hooked me. AI chips powering Teslas, cloud servers, my old gaming rig. This isn't hype, I told myself. It's the future. I bought 2 shares at $180 to $360 total, dipping into my emergency fund. No biggie, I'd be rich soon. Day 1, it's $182. Day 3, $190. I'm up $50, pacing my apartment, grinning like I'd invented the internet. This is how it's done, I thought, posting Nvidia gang on X. Friends texted back, some skeptical, some hyped. You're crushing it, one said. I felt untouchable, like I'd graduated from meme stock clown to market maestro. I'd check the app hourly, plotting my next buy, maybe $500 more when my paycheck hit. I was in control, not the crowd. Then week two hit. Nvidia dipped to $175, chip shortages in Asia, some analyst downgrade. My $50 gain shrank to $10, then a $10 loss. I refreshed, stomach tightening. It's fine, I said, scrolling for good news. Nothing but supply chain woes. I held, but the strut faded. I wasn't Buffett. I was me, still guessing, just with better headlines. The fallout. Half-baked wins. Cost you Nvidia wasn't a fluke. It climbed to $200 by summer, then $300 later. I'd caught a wave, but my genius was luck. I'd ignored risks, shortages, competition from AMD, a market cooling tech hype. My $300 could have been $500 if I'd waited, or zero if I'd bailed at 175 in a panic. Overconfidence costs when reality bites. It's not the loss, but the lesson you miss. Studies peg newbie overconfidence at a 2 to 3% annual drag. Small bets, big swagger, bigger regrets. The real fallout. I thought I'd learned GameStop's lesson, but I'd just swapped blind greed for blind pride. I wasn't investing. I was rolling dice with a fancier name. That dip shook me, not enough to sell, but enough to doubt. I jumped too fast, too sure, and the cracks showed.
Counteracting the swagger.
Bold guess feels like mastery, but it's a mirage. Here's how I'd redo it, and how you can dodge the trap. Test it. Paper trade first. Fake cash. Real lessons. I'd have seen Nvidia's swings without risking $300. Apps like Thinkorswim let you practice free. Use them. Cap it. Limit bets to 10% of your stash. $30, not $300. Small stakes keep the ego in check. Big wins don't need big risks. I'd have slept better with less on the line. Poke holes. Find one bear case, shortages, rivals, whatever, and counter it. Can't, you're not ready. I'd have paused if I'd read Supply Chain Crunch first. Behavioral guru Charlie Munger says, invert, always invert. Look for why you're wrong, not just why you're right. It's not about killing the buzz, it's about earning it.
The lesson. Smarts aren't enough.
Nvidia wasn't GameStop, but my swagger was the same old tune, different lyrics, same beat. Bold guess taught me knowledge isn't mastery, it's a start. You've got to test it, limit it, challenge it. Otherwise, you're still the kid chasing rockets, just with a fancier cape. That $300 bet didn't bust me, but it humbled me. Next time, I'd be bold with brains, not just bravado. If you're here, high on a hot tip, enjoy the ride. Just don't bet the farm until you've checked the weather.
Chapter 6. Global shock. World's messing me up. Fed rates and overseas conflicts are tanking my tech stocks. It's all connected in ways I never saw. Wish I'd caught on sooner.
Summer 2022. I stared at my phone in disbelief. Nvidia down 12% on no news? This made no sense. Fed announces 75 basis point rate hike, read the Bloomberg headline. I knew what interest rates were, sure, but why would this tank my tech stock? What the hell was a basis point anyway? 3 cups of coffee later, I was down a rabbit hole. Treasury yields, discount rates, PE compression, terms I'd skimmed past before now seemed crucial. I created a makeshift diagram on my apartment wall with sticky notes and string, connecting Powell's comments to bond prices to growth stock valuations. My roommate walked in and laughed. Planning a bank heist? Trying to understand why my portfolio's imploding when nothing about my companies has changed, I muttered. It's all connected, man, he said, grabbing a beer from the fridge. For once, his stoner philosophy was dead right. The market wasn't just stocks rising and falling on their merits. It was a living ecosystem, with currents flowing from Washington to Wall Street to Taiwan and back. I wasn't just investing in companies, I was positioning myself in global economic currents I barely understood. That night, I signed up for my first macroeconomics course online. If the world was messing with my money, I needed to understand the world.
The psychology, systems thinking awakens.
This is global shock, when you realize markets aren't isolated games, but complex systems where everything affects everything else. Your brain, wired for simple cause and effect, gets ambushed by reality's web. Psychologists call it availability bias. We focus on immediate, obvious factors, Nvidia's earnings, and miss the big picture, global monetary policy. I'd fixated on chip specs and AI potential, blind to the Fed's influence on valuations. Nobel Prize winning psychologist Daniel Kahneman explains it well. We're naturally drawn to what's right in front of us, the stock's price, the company's news, while systemic drivers remain invisible until they punch us in the face. When rates jumped, my blind spot became a crater. Complexity overwhelmed me. Then there's the local global tension. I'd built mental models for individual stocks, but had no framework for global forces. Yale economist Robert Shiller calls this narrative economics. We create stories about investments that make sense locally, but fragment when global winds blow. My Nvidia story, AI revolution, crumbled against the Fed's rate hike story, inflation battle. I wasn't wrong about AI. I was incomplete about everything else. The brain shift here is profound, moving from linear to systems thinking. It's like realizing chess isn't just about capturing pieces, but controlling the board. Rate hikes, supply chains, geopolitics, they're all moves in a game I'd only partially seen. That wall chart wasn't crazy. It was my first attempt to map reality.
The emotional shift, shock to fascination.
Emotionally, global shock starts with bewilderment. I felt blindsided, cheated almost. I did my homework, I'd protest, watching Nvidia slide on unrelated news. Anger followed. Who cares what Powell says? Then confusion. Why was everyone else reacting? Was I missing something fundamental? But here's the twist. Frustration gradually morphed into fascination. Each connection I mapped triggered dopamine, like solving a puzzle. The wall chart grew, and with it, my curiosity. I wasn't just trying to understand why I'd lost money. I was glimpsing the market's true nature. It was humbling, but exhilarating. This emotional journey marks a turning point. Chapter Five's cocky swagger dissolves into genuine awe at the market's complexity. You're no longer the protagonist of a get-rich story. You're a student of a vast, intricate system. It's like stepping outside a small town and seeing a metropolis for the first time, intimidating but magnificent.
My story, the Fed wake up call.
Let me take you to June 2022. My Nvidia position had weathered some storms, climbing to $220 after a solid earnings report. I'd added a few shares, feeling vindicated. See? Fundamentals matter, I'd tell myself, scrolling past headlines about inflation and supply chains. Tech was my world, macro was background noise. Then came the Fed's surprise 75 basis point hike, the biggest since 1994. 10-year Treasury yields rose from approximately 3% to approximately 3.4% post-hike. Markets plunged instantly. Nvidia dropped 8% that day, another 5% the next. My $220 shares were suddenly $187, then $178. My Robinhood screen blazed red, down 19% in a week. But this crash felt different, not a meme stock imploding, but the ground shifting beneath everything. It's temporary, I told myself, seeking reassurance online. Instead, I found economic debates. Rate hikes hit high multiple tech hardest, explained one analyst. PE compression inevitable, said another. It was like they were speaking Klingon. I'd focused so narrowly on chips and AI that I'd missed the tide turning. That weekend, fueled by confusion and caffeine, I created The Wall, my apartment's finance nerve center. Yellow stickies tracked Fed comments, green ones followed tech earnings, blue mapped Taiwan chip production, red highlighted inflation data. String connected the pieces, a conspiracy theorist's dream. I wasn't losing my mind. I was finding the bigger picture. Fed hikes, Treasury yields rise, discount rates up, future earnings worth less, PE contracts, growth stocks tank. I traced the path repeatedly, internalizing the chain reaction. It wasn't personal, it was mathematical. My tiny NVIDIA position wasn't just riding AI trends, it was surfing global monetary waves. I'd brought a paddleboard to a tsunami. By Sunday, I'd enrolled in a free macroeconomics course on Coursera, 8 weeks of Fed policy, yield curves, and global trade. I wasn't an expert overnight, but I was starting to see beyond my screen.
The fallout, blind spots, cost you.
The market continued struggling through summer 2022, with tech bearing the brunt. By August, Nvidia hit $150, a 32% drop from its peak. My position was underwater, and the worst part? It wasn't because AI was failing. It was because I'd been half blind to market physics. This fallout isn't unique. A 2021 study from the Journal of Financial Economics found that retail investors underperform by 1.9% annually, partly by missing macro factors. We focus on company stories while institutions watch the entire field. It's like analyzing a football player's stats without knowing the league's rules changed. The deeper cost was confidence. I wasn't just wrong about NVIDIA, I was wrong about how markets worked. My research, those 3 articles, those YouTube videos, had massive gaps. I'd been playing checkers while the market played 3-dimensional chess. The humbling was necessary, but painful. That August, I took a small step. I bought $100 of a Treasury ETF, ticker IEF, yielding 3%. It wasn't sexy like NVIDIA, but it was my first nod to the macro world. When rates rose, bonds stabilized my portfolio's bleeding edge, a toe in the water of systems thinking.
Counteracting the overwhelm, expand your lens.
Global shock can drown you in complexity, but you can navigate it. Here's how I'd approach it differently, and how you can expand your lens without drowning. Pick one thread. Start with a single macro factor. I chose interest rates. Master it before tackling inflation, supply chains, or geopolitics. I'd have learned faster focusing on one thread of my wall chart rather than the whole web. Connect it personally. Find how macro forces hit your portfolio directly. When Nvidia dropped on the Fed news, I calculated exactly how much higher rates devalued future AI earnings. $5 a share, give or take. Math makes the abstract concrete. Lean on experts. Follow one economist, one macro strategist, one Fed watcher, not 30. I found Howard Marks' memos clarified market cycles without overwhelming me. Quality beats quantity. This isn't about becoming an economist overnight. It's about expanding your awareness without losing focus. Nobel Prize winner Herbert Simon called it bounded rationality. We can't process everything, but we can widen our boundaries systematically. Start small, build gradually. The lesson: see the web, not just the strands. That rate hike shock was my first real glimpse of the market's true nature. Not a collection of isolated stocks, but an interconnected ecosystem dancing to global rhythms. I hadn't been wrong about NVIDIA's potential. I'd been incomplete about everything affecting it. The wall wasn't madness, it was clarity. If you're facing your own global shock, watching positions tank for reasons beyond earnings calls, welcome it. It's not a setback, it's an initiation. You're not seeing less, you're seeing more. Markets aren't failing you, they're revealing themselves. The web was always there. Now you're finally glimpsing it. A hedge fund manager once told me, stock pickers who ignore macro become macro's victims. I'd been a victim. Now I was becoming a student. My NVIDIA position was underwater, but my understanding was surfacing. The Fed had kicked me, but it had also kicked open a door to a bigger investment world. That Treasury ETF wasn't exciting like tech stocks, but it was a recognition that I needed balance against the forces I was just beginning to understand. My wall chart had created a new instrument for my portfolio. The world was still messing with my money, but at least now I was starting to see how.
Chapter 7. Crash Play. Buy the panic. Everyone's freaking, but I'm calm, buying quality stocks at 30% off while others panic sell. My crash protocol is working.
The headline flashed across my screen. AI stocks enter correction territory. NVIDIA down 25% from highs. It was late 2023, and 2 years after my GameStop spiral, this alert didn't faze me. Instead, it sparked a calm alertness, like a predator sensing wounded prey. I opened my crash protocol, a one-page checklist taped inside my laptop lid, scribbled with buy thresholds and rules honed over months of research. Nvidia had hit $130, down 35% from its $200 peak, right at my first trigger, buy at 30 to 40% off highs if fundamentals hold. My finger hovered over the button, and I noticed my heart rate spike, yet my mind stayed clear. Fear was there, but it didn't rule me anymore. My phone rang. Teresa from our investment forum days. "I'm selling everything," she said, voice tight. "This AI bubble's bursting." "What's changed about Nvidia's business since yesterday?" I asked, scrolling their latest earnings. Revenue up 50% year over year. AI chip demand soaring. Nothing specific, but sentiments tanking. You should sell too. Clicking buy, I added $500 worth. 4 shares at $130. Peace washed over me. Volatility wasn't my foe, it was my fuel. 3 days later, tech kept sliding. I spotted Digital Realty Trust, DLR, a data center REIT, down 22% to $90, dragged by the tech route. Its 6.2% dividend yield glared at me, $5.58 annually per share. REITs often get oversold with tech, Dr. Richards had said in a forum Q&A, but long-term leases lock in cash flow. With Fed rates peaking at 5.5% per Fred data, that yield was a lifeline. I allocated $450, 15% of my cash, not all in, but enough to count. Teresa texted, "You're nuts buying now." I grinned. Her panic was my old self staring back. By early 2024, Nvidia roared to $175, 35% gain, and DLR hit $110, 22% gain, plus $28 dividends. Jake, my coworker, noticed my calm at lunch, phone untouched. "This correction's brutal. How are you not sweating?" "Chaos isn't my enemy anymore," I said. "I've built a system that gains from it. Anti-fragility, Taleb calls it. Nvidia's my recovery bet. DLR's my shield that pays to wait." I wasn't surviving disorder. I was thriving in it, financially and mentally.
The psychology, anti-fragility in action.
Crash Play flips the script. Where most see risk, you see reward. Nassim Taleb's Anti-Fragile argues some systems don't just resist chaos, they improve from it. My protocol wasn't about avoiding crashes, it was about profiting from them. Behavioral finance calls this contrarianism, bucking the herd when panic peaks. The amygdala still screamed, "Danger!" Evolutionary wiring doesn't vanish, but my prefrontal cortex took the wheel. Studies show panic selling peaks at market bottoms. Dalbar, 2021. Retail investors lose 1.5% annually to timing. I'd trained myself to see red as green, volatility as opportunity. It's not denial, it's rewiring. Confirmation bias flipped too. Teresa saw a bubble bursting. I saw oversold value. Psychologists say we seek data to fit our fears. I sought data to fit my rules. Nvidia's PE dropped from 60 to 40, still above its 5-year average, 35, but screaming buy with 50% revenue growth.
The emotional shift, fear to focus.
Emotionally, Crash Play is a tightrope. Fear lurks, but focus wins. My palms sweated buying Nvidia, yet I felt calm, a paradox I'd mastered. Panic was my signal, not my master. When DLR dipped, I didn't flinch. I calculated 6.2% yield at $90 beat the 10-year Treasury's 4.5%. Pride wasn't cocky here, it was quiet confidence in my system. Friends sold, I bought. Their texts, "You're crazy," echoed my past, but I'd outgrown it. Relief came not from dodging losses, but from embracing dips as wins. My story, the 2023 correction. Late 2023 hit hard. AI hype faded, rates bit, and tech tanked 20% in Q4. S&P 500 Tech Index minus 18%. My $3,000 portfolio, 60% VTI, 20% VXUS, 10% VNQ, 10% BND, dropped 12% to $2,640. Pre-crash. Play me would have frozen. Now I acted. My protocol had three rules. 1. Buy quality at 30 to 40% off highs. 2. Check fundamentals, revenue, PE. 3. Limit bets to 20% cash. Nvidia fit. Down 35%, revenue up 50%, PE at 40 versus 60. I bought $500. DLR checked out. Down 22%, 6.2% yield, stable leases. I added $450. By January 2024, markets rebounded. Nvidia hit $175, 700 total plus 40%. DLR reached $110, $550 total plus 22% plus $28 dividends. My portfolio recovered to $3,200, up 6.7% from pre-crash, beating the S&P's 4% bounce. Chaos paid.
The fallout, missing the bottom.
Crash play isn't flawless. I bought Nvidia at $130. Great, but it bottomed at $120 a week later. DLR dipped to $85 before climbing. Timing exact lows is a myth. Studies show even pros miss by 5 to 10%. Morningstar 2022. The cost? Opportunity, not loss. I still won long term. Confidence grew, but overconfidence loomed. Could I chase every dip? No, my rules kept me grounded. Socially, I drifted from panic-driven friends, but teaching Teresa my protocol rebuilt bonds.
Counteracting the chaos.
Crash play thrives on preparation, not reaction. Here's how. Build a protocol. List triggers, e.g., buy at 30 to 40% off, PE less than 50, revenue growth greater than 20%. I tape mine inside my laptop. Check the math. Compare PE, yields to averages, e.g., Nvidia's 40 versus 5-year 35 inches, data beats gut. Limit exposure, cap buys at 20% cash, e.g., 500 max per dip. Greed stays caged. Taleb says, don't predict chaos, profit from it. I didn't guess the crash. I planned for it. Progress wasn't perfection. It was playing the odds smarter.
The lesson. Chaos is your ally.
That 2023 correction wasn't a setback. It was a proving ground. I didn't outsmart the market. I outlasted its tantrums. If you're facing a crash, red screens, racing pulse, lean in. Build your protocol. Trust your rules. Chaos isn't your ruin. It's your rocket fuel.
Chapter 8. Calm gains. Steady's my win. I don't check my portfolio obsessively anymore. Auto investments hum along, building wealth slow and steady, chasing hypes out, sleeping easies in.
Early 2024. I closed my investment spreadsheet with a satisfaction that felt nothing like the manic highs of my GameStop days. My portfolio was up 11.3% for the year. Solid, not spectacular, but meaningfully ahead of my 8% benchmark. More importantly, I'd slept well every night. My phone hadn't been opened to a trading app at 2 a.m. in over 6 months. The automatic transfers executed like clockwork, 60% to VTI, total U.S. market, 20% to international, split between VEA and VWO, 10% to VNQ, REITs, 10% to BND, bonds, rebalanced quarterly by selling 5% VTI to reset BND back to 10% when needed. VTI's 0.03% fee kept costs low. I still maintained a small exploration fund for individual stocks, but even that followed rules rather than impulses. You seem different, Maya said over coffee. She was new to investing, excited about a crypto trading course she'd discovered online. The old me would have felt FOMO, maybe even jumped in alongside her. The new me felt something else: concern. I learned the hard way that excitement and investing don't mix well, I said carefully. But don't you want to make big returns? She asked, showing me a screenshot of some influencers' claimed crypto gains. I pulled out my phone and showed her my own screen, not of returns, but of a sleep tracking app. My average sleep quality had improved 47% since switching to systematic investing. The returns aren't just financial, I said. What would you pay for peace of mind? Later that night, I transferred my monthly $600 into my accounts, the same process I'd follow whether markets were up 20% or down 30%. As I closed the laptop, I realized something profound had shifted. I no longer needed the market to be exciting. I no longer needed to be right about individual stocks. I needed the process to be right and to keep following it decade after decade.
The psychology process rules outcomes.
Calm gains represents a psychological revolution in how you evaluate success. Poker champion and cognitive scientist Annie Duke calls this thinking in bets, shifting focus from results to decisions. In my GameStop days, I judged myself by outcomes. I lost money, I'm a bad investor, or I made money, I'm a genius. Now I evaluated process. I followed my system. I succeeded regardless of short-term returns. This shift rewires the brain's reward circuits. Neuropsychologists find that consistency activates different neural pathways than gambling-style wins. Former poker pro and decision scientist Maria Konnikova explains that amateurs chase the dopamine rush of victories, while professionals find satisfaction in correct decisions, even when they lose. My automatic transfers weren't exciting, but they created a different kind of high, the calm of knowing I was playing the right game. Psychologists call this transition delayed gratification, trading immediate thrills for future stability. Walter Mischel's famous marshmallow experiments showed that children who could wait for two treats instead of grabbing one immediately had better life outcomes decades later. I'd been a marshmallow grabber with GameStop. Now I was building the patience muscle that Mischel's research linked to success. There's also detachment at work. Behavioral economists note that frequent portfolio checking correlates with higher stress and worse decisions. By checking quarterly instead of daily, I'd broken the emotional feedback loop that drove panic and greed. It's why meditation practitioners describe watching thoughts without attachment. I could observe market movements without reacting to them. That 11.3% return wasn't a personal victory, it was just data. This mental shift is subtle but powerful. Your identity shifts from market player to system builder. You're not fighting the market anymore. You're designing a machine that works with it. Like a farmer who plants seeds and trusts the process, you're setting conditions for growth rather than forcing it.
The emotional piece, quiet pride.
Emotionally, calm gains feels like coming home after a long journey. The frenetic energy of earlier stages, the greed surges manic high, the crash panic's desperate lows, fades into steady contentment. I still felt emotions, but they were muted, like waves viewed from a cliff rather than experienced in a boat. It's not that I didn't care about money, I did, but the emotional roller coaster had flattened into a gentle path. Bad days didn't destroy me. Good days didn't inflate me. When my right holdings dropped 6% on interest rate rumors, I noted it with curiosity, not panic. When my international ETFs jumped 4% on currency shifts, I acknowledged it with a nod, not euphoria. The drama was gone, peace remained. Pride still existed, but transformed. Instead of the cocky swagger of nailing a stock pick, I felt the quiet dignity of maintaining discipline. When friends bragged about catching the latest meme coin surge, I didn't feel envious or superior, just patient. My spreadsheet's steady climb wasn't Instagram worthy, but it was mine. My system, my peace. There was also relief, the pressure to be brilliant, to catch every trend, to outthink Wall Street. It had evaporated. I'd accepted that I couldn't outsmart the market, but I could outdiscipline most players. That surrender actually felt like freedom. I wasn't Atlas carrying the world. I was a gardener tending a plot, knowing that some seasons would be better than others, but the garden would grow either way. My story, the ETF shift. Let me take you to January 2024. After my rate hike awakening in 2022 and some contrarian plays in 2023, I'd spent months building a system that reflected my hard-won wisdom. My Nvidia bet was still there, but reduced to 5% of my portfolio. A reminder, not a centerpiece. The bulk now lived in broad index ETFs, bought automatically every payday. The system wasn't sexy. I'd set up recurring transfers through my bank. $300 to VTI, total US market, $100 to VXS, international, $50 to VNQ, REITs, and $50 to BND, bonds. VTI averaged approximately 12% in 2023, boosted by a 26% S&P rally. Every 3 months, I'd spend 30 minutes rebalancing if any allocation drifted more than 5% from targets. If VTI grows to 65%, sell $300 to buy 200 BND, 100 VXUs. Portfolio volatility approximately 8% versus S&P's 15% per ETF data. That was it. No daily checking, no Reddit threads, no 2 a.m. limit orders, just steady, boring discipline. Bitcoin's going to $100,000. My coworker Jake insisted that month, showing me charts on his phone. You're missing out, man. 2 years earlier, I'd have jumped in, terrified of missing the rocket. A year ago, I'd have researched intensely, looking for an edge. Now, I just smiled. Maybe it will, I said. My system doesn't need it. He looked at me like I'd grown a second head. You're leaving money on the table. But I wasn't leaving money. I was leaving stress, sleepless nights, and the emotional whiplash of chasing trends. My spreadsheet told a quieter story. My boring portfolio had returned 11.3% over the past year, with a third of the volatility of the S&P 500. I'd slept through 3 market corrections that had Jake panic texting at midnight. That night, I saw Bitcoin jump 15% on some executive order news. The old FOMO twitched briefly, then faded. Instead of obsessing, I opened my sleep tracker app. 47% improvement in sleep quality since my systematic shift. Some returns didn't show in my account balance, but they showed in my life. Investing should be like watching paint dry, Warren Buffett once said. If you want excitement, take $800 and go to Las Vegas. I'd finally internalized the wisdom. When my $600 auto transfer hit the next day, I didn't even check what prices the ETFs purchased at. The system was working. I didn't need to hover.
The fallout, complacency lurks.
Calm gains isn't perfect. The biggest risk now wasn't panic or greed, but a new enemy, complacency. Systems need maintenance and markets evolve. By April 2024, my international allocation had underperformed for 8 straight months. The easy path was to ignore it. The system was working overall, right? But that would have been a different kind of mistake. After some research, I realized my broad international ETF was heavily weighted toward Europe and Japan, missing emerging markets growth. I hadn't adjusted my allocations to account for this blind spot. Comfort had created a new form of tunnel vision, not daily panic, but quarterly complacency. Studies confirm this risk. Research from Vanguard shows that investors with automatic plans often ignore their allocations for years, missing significant shifts in global markets. One paper called it set and forget fallacy, the belief that a good system never needs adjustment. I'd overcome emotional chaos only to risk strategic stagnation. The other fallout was social. My investment conversations grew shorter, less exciting. When friends talked crypto surges or meme stocks, I had little to add. I just follow my system doesn't make for thrilling happy hour chatter. I'd gained peace, but lost some connection with the investing community that once energized me. Yet these costs seemed minor compared to the benefits. My account grew steadily. My sleep improved markedly. My mind had space for other pursuits. I'd started learning Spanish, something I'd never had the mental bandwidth for when markets consumed me. Calm gains had trade-offs, but they were trade-offs I chose consciously.
Counteracting the complacency.
Calm gains has pitfalls, but they're manageable. Here's how I navigated them. and how you can maintain discipline without stagnation. Tune up, don't tear down. Review your system quarterly, but change parameters annually at most. I adjusted my international allocation to include an emerging markets ETF, VWO, but kept the overall 20% foreign exposure steady. Evolution, not revolution. Stay curious, not reactive. Read one investing book per quarter to keep learning without obsessing. I added Devil Take the Hindmost, a history of market manias, to understand cycles, not to trade them. Knowledge doesn't have to trigger action. Celebrate process, not just returns. Create metrics beyond money. I tracked my sleep quality, my stress levels, even the number of days I didn't check my portfolio. These wins counted even when markets dipped. Legendary investor Howard Marks says the key isn't avoiding mistakes, but ensuring they're new ones. I'd moved from the emotionally driven errors of my past to the more subtle risk of system rigidity. Progress wasn't perfection, but it was certainly progress. The lesson: steady's true strength. That 11.3% return wasn't the real victory of calm gains, it was the mental freedom, the emotional stability, and the life energy redirected from market obsession to actual living. The system wasn't perfect, no system is, but it matched my temperament, my goals, and my hard won understanding of myself as an investor. If you're reaching this stage, if the market's daily dramas affect you less, if you trust your process more than your impulses, congratulations, you've accomplished something more valuable than catching the next surge. You've built sustainable habits that compound not just money, but peace. Maya never took that crypto course. Instead, she opened a Vanguard account with a three-fund portfolio I helped her design. When Bitcoin crashed 22% the following month, she texted a simple, "Thank you." She'd skipped some painful lessons I'd had to learn firsthand. The markets will always offer temptations. The next GameStop, the next crypto boom, the next sector rotation that changes everything. Calm gains isn't about ignoring these entirely. It's about viewing them through a lens of systematic thinking rather than emotional reaction. You can still explore edges of markets, but from a foundation of stability, not desperate swings. My spreadsheet's steady climb continued, not exciting enough for Reddit screenshots, but reliable enough for real-life goals. The GameStop fever dream had faded into something better, not a momentary high, but a sustainable path. Steady wasn't just a strategy, it was strength.
Chapter 9: Steady Wins. Teaching Others Now.
My system's refined and resilient now. Each market shift makes me more confident, not nervous. Teaching others this path feels better than any trade I've ever made. Late 2024. The notification popped up on my phone. Market down 3% on recession fears. 3 years ago, I'd have panic-checked my portfolio. Today, I dismissed the alert and continued my lunch. "Aren't you going to see how bad it is?" Teresa asked, watching me put my phone face down. "My system's designed for days like this," I replied, taking another bite of my sandwich. "Besides, what would I do differently?" Teresa frowned. We'd met in an investment forum years ago. She was the one who'd called me nuts for buying during the 2023 correction. Now, ironically, she was the one checking her phone every 5 minutes during market dips. "I don't understand how you stay so calm," she admitted. "Don't you worry about your money?" I pulled out a pocket notebook, a habit I'd started 6 months earlier. Inside were daily entries, not of stock prices or market moves, but of my investing behaviors and emotional reactions. Today's was simple: market drop notification. Felt brief anxiety, then remembered system, didn't check portfolio, continued lunch. "I worry about my decisions, not the market," I explained, showing her the notebook. "And right now, my decision is to enjoy this sandwich and trust the plan." That evening, I settled in for my monthly portfolio review, a ritual I'd refined to exactly 30 minutes on the last Sunday of each month. My spreadsheet showed the 3% market drop had translated to a 2.2% dip in my diversified holdings. My emerging markets position, added after Chapter 8's complacency warning, had actually gained slightly, offsetting some domestic weakness. V-tip countered 2 to 3% inflation per Fed data. Portfolio volatility approximately 8% versus S&P's 15% per ETF data. I made a single adjustment, a $500 contribution to my bond allocation, which had drifted below my 10% target. Then I closed the laptop and opened a novel. No market news, no financial YouTube, no checking if others were panicking. I used Portfolio Visualizer to track allocations. The system was working as designed, handling volatility without requiring my emotional energy. My monthly $600 auto deposit would execute tomorrow, $360 to total market ETFs, $120 to international, split between developed and emerging markets, $60 to REITs, and $60 to bonds. The same deposit I'd make if markets were soaring or crashing, the same allocation I'd developed through painful trial and error, the same process that had transformed investing from an emotional battleground into a quiet background engine of my financial life. As I reflected on my journey, I realized I'd completed all 9 stages of the investor cycle, from Chapter 1's greedy GameStop surge to today's steady system. The notebook wasn't just tracking behaviors, it was documenting a transformation. I hadn't overcome market volatility, I'd overcome myself.
The psychology, integration, and evolution.
Steady wins represents the final psychological integration of your investing journey. Psychologists call this self actualization, when knowledge doesn't just change behavior, but transforms identity. I wasn't following a system, I was the system. The notebook, the monthly review, the automatic deposits, they weren't things I did, but expressions of who I'd become. Harvard psychologist Ellen Langer describes this as mindful investing, complete awareness of your behavior patterns without being controlled by them. That brief anxiety I felt at the market drop notification, I noticed it, acknowledged it, and moved on, what meditation practitioners call non-attachment. The emotion didn't control me because I recognized it as just information, not a command. Gross's reappraisal took years to master. Then there's hedonic adaptation, our tendency to return to baseline happiness regardless of circumstances. Psychologists used to see this as a limitation. Lottery winners and accident victims return to similar happiness levels. But in investing, it's a superpower. Market surges didn't thrill me. Crashes didn't devastate me. I'd adapted to seeing them as normal fluctuations rather than emotional events. My happiness derived from the process, not the outcomes. Most profound was the shift to legacy thinking. Developmental psychologist Eric Erikson described life's final psychological stage as generativity versus stagnation, the need to create something that outlasts you. Teaching Teresa, helping Maya, these weren't distractions from investing, but the culmination of it. I wasn't just building wealth, I was building wisdom and passing it on. This integration happens when knowledge doesn't just inform decisions, but reforms how you experience markets entirely. It's like learning to drive. At first, you consciously check mirrors and signals. Eventually, you just drive. I wasn't doing investing anymore. I was simply an investor, operating from a place of integrated wisdom rather than fragmented tactics.
The emotional equilibrium beyond highs and lows.
Emotionally, steady wins feels like finding your sea legs after years of motion sickness. Markets still move, sometimes violently, but you move with them rather than against them. It's not numbness, it's equilibrium. When my total portfolio crossed $8,500 that October, a milestone I'd once thought would feel monumental, I noted it with a small smile and continued my day. No screenshot sharing, no celebration dinner, just quiet acknowledgement. Similarly, when a Fed announcement triggered a 2-day 5% drop the following week, I felt a flicker of concern but no panic. The emotional amplitude had narrowed dramatically, not because I cared less, but because I trusted more. There's a certain melancholy, too. The thrills of Chapter 1's big gambles, the drama of Chapter 3's desperate sells. They're gone. Like an adrenaline junkie who's found meditation, part of me occasionally missed the intensity. But that nostalgia faded when I remembered the sleepless nights, the stomach knots, the relationship strain when I was snapping at friends during market dips. The dominant emotion became trans-temporal satisfaction, pleasure derived not just from current results, but from knowing I'd created a sustainable path. Philosopher Martin Seligman calls this meaningful happiness, joy connected to something larger than momentary pleasure. My satisfaction wasn't just about today's returns, but about decades of potential growth, about financial security extending beyond my lifetime. Most surprising was the social emotion, connection through teaching rather than trading. Explaining dollar cost averaging to Teresa or helping my nephew open his first Roth IRA delivered more genuine happiness than any successful trade. It wasn't just about money anymore, it was about meaning.
My story, the system matures.
Let me take you to October 2024. After nearly 4 years of investing, from GameStop chaos to systematic calm, I'd refined my approach into a resilient machine that required minimal maintenance but delivered consistent results. My portfolio had grown to just over $8,500. Not retirement money, but meaningful progress from the $500 GameStop gamble. The asset allocation had evolved with my understanding. 60% broad market ETFs, VTI and VOO, 20% international, split between developed markets VEA and emerging markets VWO, 10% REITs, VNQ, and 10% bonds, a mix of BND and VTP for inflation protection. I maintained a small 5% exploration fund for individual stocks like Nvidia, but even these followed strict rules. No position larger than 1% of my total portfolio, no emotion-driven trades. The real innovation wasn't the allocation, but the behavioral system surrounding it. Monthly reviews, 30 minutes on the last Sunday of each month, no more, no less. I'd check allocations, make one adjustment if needed, and close the computer. Daily journaling. A pocket notebook tracked emotional reactions to market moves, creating awareness without action. Felt FOMO when friend mentioned Tesla gains. Noted feeling, didn't act. Emotion passed within 20 minutes. Quarterly learning. One investing book every 3 months focused on psychology and history rather than tactics. Finished Peter Bernstein's Against the Gods, The History of Risk, without feeling compelled to change anything. Annual strategy review. A deeper December assessment where I'd question fundamental assumptions and make measured adjustments. Last review added inflation-protected bonds and emerging markets based on evolving understanding. The system worked not because it was perfect, but because it was appropriate for me, matched to my psychology, my time horizon, my goals. It wasn't a straitjacket, it was a well-tailored suit, allowing movement within boundaries. When Teresa texted about the market drop that October, I realized how far I'd come. A message that once would have sent me sprinting to my trading app now prompted a calm explanation of volatility and long-term thinking. I wasn't just practicing these principles, I was teaching them. I've never understood how this works, she admitted over coffee the following week. I buy when everyone's excited and sell when everyone's scared. I showed her my notebook, my spreadsheet, my automatic transfer receipts, not to boast, but to illuminate. The goal isn't perfect timing, I explained. It's removing timing from the equation entirely. She opened a brokerage account that afternoon and set up her first automatic investment. Watching her excitement reminded me of my own journey, the mistakes, the lessons, the eventual peace. I hadn't just built a portfolio, I'd built a transferable framework.
The fallout, when calm becomes complacent.
Steady wins isn't immune to risks. By late 2024, my biggest threat wasn't market volatility, but system stagnation. My quarterly learning had slowed. My annual review was approaching with less fresh thinking than previous years. I'd found a comfortable groove, but grooves can become ruts. Financial theorist William Bernstein warns about strategy decay, the tendency for investment approaches to lose effectiveness as markets evolve and more investors adopt them. My diversified ETF approach wasn't revolutionary. What if changing conditions demanded adaptation I was too comfortable to make? Research from investment firm Research Affiliates shows that even indexing, once revolutionary, faces challenges in a world of heightened valuations and environmental disruption. Was my set and forget approach missing crucial shifts? Was stability morphing into rigidity? There were also opportunity costs. While my system generated steady 8 to 12% returns, certain sectors experienced dramatically higher growth. Had I stayed more active, could I have captured more upside? The question wasn't whether my approach worked, it did, but whether it was optimal for changing conditions. These doubts weren't panic or FOMO, but legitimate strategic questions. The danger of steady wins isn't emotional chaos, but intellectual complacency, confusing peace with perfection. My system wasn't the final answer, it was the current best iteration of an evolving approach.
Counteracting the stagnation.
Steady wins requires vigilance against complacency. Here's how I kept my system alive rather than fossilized. Challenge your comfort. Deliberately seek opposing views quarterly. I subscribe to a value investing newsletter despite being mostly indexed, not to follow their picks, but to question my assumptions. Fresh Eyes Review. Once yearly, have a knowledgeable friend review your system. My mentor Carl spotted over-reliance on U.S. large caps that I'd become blind to through familiarity. Small Experiments Fund. Allocate 1% to test new approaches without disrupting your core system. I tried a small position in a climate transition ETF, not as a world-changing bet, but as a learning laboratory. Investor and author William Bernstein suggests we get the big things right and don't sweat the small stuff. 90% of results come from basic asset allocation and behavior management. My experiments and adjustments happened within that 10% margin, letting me evolve without endangering the core.
The lesson: the journey never truly ends.
That market dip in October 2024 wasn't the final test of my investor journey. There is no final test. Markets will continue evolving, my knowledge will continue deepening, my system will continue refining. What's changed isn't the challenges, but my relationship to them. I'd moved from being market driven to being process driven, from reacting to creating, from fearing volatility to incorporating it. The GameStop gambler had become a systematic investor, not through sudden transformation, but through cyclical growth, each stage building on lessons from the last. If you're approaching this stage, if you've developed a system that matches your psychology, if market moves affect your emotions less than your own decisions, if teaching others brings more satisfaction than trading, congratulations. You haven't reached the end, you've reached the beginning of sustainable investing. Teresa's first automatic investment executed in November 2024. It felt weird, she said. No excitement, no research rabbit holes, just a transfer. I smiled, recognizing her Chapter 1 self, standing at the starting line I'd crossed years earlier. She had her own journey ahead, but perhaps with fewer scars than mine. The markets will always offer drama. Booms, busts, revolutions real and imagined. Steady wins isn't about ignoring these cycles, but transcending them, building an approach that performs through them rather than attempts to predict them. My notebook entry that night was simple. Helped Teresa start auto investing. Felt more satisfaction from this than from any trade I've made. The 9-stage investor cycle hadn't just changed my portfolio, it had changed me. And that, beyond any return, was the greatest gain of all.
Chapter 10: The Integrated Investor. From past lessons to future growth.
By 2025, my portfolio hit $5,800, a 15% annualized return since 2021, outpacing the S&P 500's 12% per SPY data. It wasn't just dollars, it was a new lens. The GameStop chaos that cost me $380 4 years ago hadn't broken me. It built me a framework for decades ahead. My next move wasn't a stock, it was a skill. Options. Not the YOLO calls of my meme stock days, but covered calls on stocks I owned. For 3 months, I paper traded, logging mock sales, e.g., SPY at $450, sold $460 calls for $2 each, netting $200 if exercised. My first real play wrote a $480 call on 100 SPY shares at $470, earning $50 in premiums. Carl grinned over coffee. Options are tools, not toys. Use them right. They pay. That 2% boost, annualized approximately 8%, turned volatility into my ally, echoing Chapter 7's crash play in slow motion. I sketched a 10-year vision on a napkin. Not wild bets, but a deliberate map. Years 1 to 2. Master covered calls, leveraging Chapter 8's anti-fragility, e.g., $500 per month premiums on $25,000 equity. Years 3 to 5, carved 10% for real estate. Start with REITs, VNQ, then a rental, guided by Chapter 6's macro lens. Rates stabilized at approximately 4.5% per FRED. Years 6 to 10. Deepen international exposure. Scale VWO to 15% as emerging markets grew. MSCI EM plus 8% average. Guardrails kept me steady. No more than 8% in one property market. No lump sum gambles. GameStop's ashes taught me that. Teresa texted one night, "Thoughts on dollar cost averaging?" The skeptic from Chapter 7 was now a pupil. Maya ditched crypto hype for our monthly index talks. "Investing's about not screwing yourself," I told her. A truth I'd lived. Crypto soared 30% that week. FOMO flickered, but I stuck to my $500 monthly split: 60% VTI, 20% VXUS, 10% VNQ, 10% BND. Wealth wasn't screen glow. It was quiet confidence. My system outlasted impulses.
The psychology. Integration over instinct.
The integrated investor fuses all 9 stages into a whole greater than its parts. It's Maslow's self-actualization, psychology's peak where knowledge becomes identity. Chapter 1's FOMO taught me triggers. Chapter 5's overconfidence showed my limits. Chapter 9's hedonic calm leveled my emotions. Now I wasn't reacting, I was orchestrating. Behavioral finance calls this metacognition, thinking about thinking. Studies show self-aware investors outperform by 1 to 2% annually. Barber and Odeon, 2000, not from genius, but discipline. My amygdala still buzzed at dips, but my prefrontal cortex ran the show, asking, "Does this fit my rules?" Crypto's 30% didn't. VTI's 10% dip did. Loss aversion faded. I saw red as tuition, not tragedy. Confirmation bias flipped. I sought flaws in my bets, not wins. Taleb's anti-fragility became my spine. Every crash sharpened me, not shattered me.
The emotional anchor. Purpose beyond profit.
Emotionally, this stage is ballast, steady through storms. Gains didn't thrill, losses didn't sting. When SPY hit $480, my $50 premium felt routine, not triumphant. A 5% dip in VXs? A shrug, not a sweat. I'd seen worse. Pride was purpose now. Teaching Teresa DCA or Maya index funds outshone any trade. Erickson's generativity took root. My legacy wasn't cash, but clarity for others. Nostalgia for Chapter 1's rush faded. Sleepless nights weren't worth it. Satisfaction spanned time. Seligman's meaningful happiness. My $5,800 wasn't today's win, it was tomorrow's foundation. Decades of growth, security beyond my years.
My story, the long game.
By 2025, my $5,800 reflected 4 years of chaos and calm. Contributed approximately $500 per year since 2021, totaling $2,000. Yearly tally: 2021, $500 in, negative $380 out, $120 left. 2022, $1,800 in, minus 20%, $1,440. 2023, $1,800 in, plus 26%, $3,710 total. 2024, $1,800 in, plus 10%, $5,800 total. Options added approximately $300 in premiums, small, but a proof of concept. Teresa's DCA, $200 per month into VTI, hit $2,500 by year end. Maya's three fund, $100 per month, reached $1,200, teaching them beat any gain.
The fallout, adaptation's edge.
Integration isn't static, markets evolve. My 60-20-10-10 worked, but 2025's 3% inflation CPI data nudged me toward VTIP up to 5% of bonds. Overconfidence risked stagnation. Bernstein's strategy decay loomed. I missed crypto's 30%, but my 15% beat its volatility. Bitcoin's 50% drawdowns. Socially, I leaned into mentorship. Carl's gruff nods became my benchmark. Opportunity costs? Sure, but stability trumped speculation.
Counteracting the future.
Integration demands vigilance. Map it. Sketch your decade, e.g., years 1 to 2, $500 per month calls, years 3 to 5, 10% REITs. Test it. Paper trade new moves, e.g., mocked $480 SPY calls, net $50. Teach it. Share your system, e.g., showed Teresa DCA's math, $200 per month equals $2,500. Buffett says, risk comes from not knowing what you're doing. I knew my game. Chaos didn't scare me. It sharpened me.
The lesson, thrive through cycles.
That $5,800 wasn't the end. It was the start. Markets will crash, bubbles will burst, but I'm not the GameStop kid anymore. I'm the writer. Every dip a chance to grow stronger. Every lesson a brick in my framework. True wealth? Knowing the next storm won't sink me, it'll sail me forward.
Epilogue, the test, spring 2026.
The notification pinged, markets down 8% on surprise rate hike after oil spiked to $120. It was May 2026, and 5 years after GameStop, the Fed had jolted Wall Street to tame inflation. I closed the alert and continued my morning coffee. No racing heart, no desperate app checking, no frantic texts to friends. I'd been through this before, many times now, but today felt different. My portfolio screen showed red across the board. The tech-heavy ETFs were down 12%, REITs off 9%. Even my boring dividend stocks had dipped. 2 years earlier, my covered call strategy would have softened the blow, but I'd scaled that back to fund my latest move. A real estate syndicate with 5 partners, pooling $50,000 for an apartment building, step 1 of Chapter 10's 5-year real estate plan. I scrolled through my messages. Maya texted, "Everything's crashing. What now?" Teresa sent an exploding head emoji. Carl forwarded an article on rate cycles. Corrections plant seeds. Time to water yours. I replied to all, following the plan. The plan was no longer a sticky note or a checklist. It had evolved into a philosophy. Each stage of my journey had contributed something essential. Chapter 1's greed surge taught me to recognize emotional triggers. Chapter 8's crash play trained me to see volatility as opportunity. Chapter 9's calm gains embedded systematic thinking. In my journal, a habit since year 3, I wrote, markets red, feeling curious, not scared. If correction hits 15%, boost REITs, volatility's my old friend now. With that, I closed my laptop and headed to work. The true test of an investor isn't what they do during a bull market. It's how they respond when plans collide with reality. Today's drop wasn't the first, and it certainly wouldn't be the last. Markets would surge and crash again. Bubbles would bloom and burst, but I wasn't their passenger anymore. I was their rider. 5 years of the 9-stage cycle hadn't just built a portfolio, it had forged a lens to see chaos as opportunity, every dip a chance to grow stronger.
To the reader.
Dear reader, what you've just read isn't pure fiction. It's a path many investors travel, though few recognize the patterns until they've lived them. Perhaps you saw yourself in the GameStop frenzy, the desperate selling, or the calm gains. Maybe you're still cycling through these stages, wondering when the emotional roller coaster ends. I invite you to journal your own investor journey. Where are you in the cycle? What triggers your greed surges or crash panics? What systems might help you ride the waves rather than be carried by them? The journal entry in the epilogue isn't just a literary device. It's a practice that transformed my relationship with investing. A simple note during market volatility, feeling curious, not scared, can be more valuable than any stock pick or technical analysis. Your cycle may not mirror mine exactly. Your chapter 8 might look different from my contrarian plays. Your final stage might emerge from unique experiences. The point isn't to follow my path step by step, but to recognize your patterns, name them, and gradually build a framework that turns market chaos from an enemy into an ally.
The journey from passenger to rider is available to anyone willing to face their financial psychology honestly. It's my hope that by sharing mine, I've illuminated yours.